Interest rates have gone up in the UK as well. And two things I saw today, house prices have dropped for, I think, the second or third month in a row. And also a consumer spending at retail spending is its lowest since the pandemic. So, and there can be a wide range of reasons for this. There is, inflation and such, but usually when this happens, they reduce interest rates and print more money. So would you say that the Bank of England, the Fed are finally allowing a contraction to happen? Because they haven't allowed it previously. They've kicked the can down the road. We've gone other times of surpluses and deficits. It's stimulate until the point where they can't stimulate anymore. Do you believe they're going to allow a full contraction, or do you believe this is temporary and they're going to start printing again?
That is the $83 trillion question that you're asking.
2.1 quadrillion sats question.
That's right.
Quadrillion? Well, it's actually slightly under 2.1 quadrillion.
It is. And the answer to your question is a tough one, but they have stated that they are rooting for the contraction. It's not just like they're allowing the contraction to happen for the first time since 2009. They are actually rooting for it this time because of how high inflation has reached. So if you read what the Fed is saying, they're talking about we're actually hoping to see a higher unemployment number because that will bring down wages, which will bring down inflation. So they're using their central bank 101 right now, which is if inflation is high, raise rates, slow the economy, bring inflation down. And when the economy is down, the central banking 101 is to lower rates and to bring demand back up. So they are using their usual playbook or like the textbook, which is that if inflation is high, raise rates and slow the economy. But they're doing it in a way right now that, again, it's all about their reputation.
Reputation with who?
The public. Because if the Fed caves, okay, let's say you're right, we've had 2 consecutive now monthly declines in U.S. home prices. Or I think 1 or 2. The one was 0, and then we've actually seen a nationwide month-over-month decline in home prices. That means the economy is slowing, right? Higher interest rates have had an effect. But if we get a few more negative home price months, or we get increase in firing, or we get a slowdown in economic activity, but inflation is still high, per the Fed's own rhetoric, they will keep hiking because it's not enough. It wasn't enough. And so that's where I think the reputation comes in, is that the only thing they care about right now is the public's perception of 8% CPI. And so they'll do anything that they can to get it down. But
if they crash the housing market and crash the economy,
they won't be able to crash the housing market and the economy fully. And the reason is because the reason that the Fed will have to stop hiking rates is not the economy.
Okay.
It is internal financial plumbing and other financial metrics that will, if those break, cause depression-like situations in the economy. Right. So those are things like money market rates or corporate borrowing or what's going on in Europe. Let's say dollar funding in Europe, which is European banks trying to borrow dollars. They're not able to get them, so they're having to pay up. Emerging markets starting to break. Those are the types of things that send the financial system into like a freeze state where banks stop answering the phone when another bank calls them. That is what's going to get the Fed to stop hiking rates. And that will be a tap on the shoulder, not a recession headline in the Wall Street Journal or housing price crash on CNBC. It's going to be something way more nuanced. It's going to be tough to predict. I think something to do with Europe.
Yeah, so who brought that up previously? Somebody said that the US will have to protect Europe from crashing.
That's correct. I agree with that fully.
Who was it who said that?
I can't remember.
It might even have been Jeff.
So is what you're saying there kind of what happened in a very small scale in the UK 2 weeks ago, whenever it was.
So in the UK, it was like I was saying, it's hard to predict. I think that's the takeaway from what happened in the UK. You have pension funds that have all these UK government bonds, right? They're not supposed to care about mark-to-market losses because the liabilities are 30 to 50 years. But they didn't only have bonds. They had derivatives. And the derivatives, if they go down in price, remember, no money exchanged place on day one in that derivative. The bonds that they purchased, they had to wire that money.
Mm-hmm.
You don't have that money. You just have the bond. You have custody of the bond.
Hold on. Is this why historically pension funds usually have quite strict rules on what they can put money into?
Yes.
And is this a relaxing of the rules that's happened in the UK specifically?
I don't know the rules in the UK that allow this, but I do know that pension and life insurance funds in the United States are heavy participants in the interest rate swap market, which is the derivatives market. It's the synthetic bond market.
Right.
So US pension funds are in the synthetic bond market. UK pension funds are in the synthetic UK bond market. And synthetic, I mean by interest rate swaps, that's a derivative. If you're long an interest rate swap, it means you're receiving a fixed coupon, just like in a bond. Now, the difference is that you have to pay a floating coupon, which is the pretend borrow, which is like the analogy is with repo. If I have a U.S. Treasury security, or let's say I want to buy a U.S. Treasury security, but I don't have any money, and I'm a bank, I can buy that security and finance the trade at the same time and basically only have to spend 2% of the bond. But I don't get the full coupon, meaning that, let's say the coupon is 3%.
So for people listening, because Greg talks about coupons, but help them understand what a coupon means.
Yeah, a coupon.
So for us, a coupon is 20p off a parcel.
Sure.
That you cut out of the paper.
So a coupon bond is a fixed income instrument. Let's call it a 10-year bond with a 3% coupon.
Okay.
Now, in US, the coupons are paid semi-annually, which means that every 6 months, I will get $1.50 on my $100 bond for the next 10 years. Yeah. So 20 payment periods. I will get 1.5, 1.5, 1.5. And at the last payment period, I'll get 100 plus 1.5.
It was one of the weirdest things to get my head around when I first started to understand or talk about bonds or ask people questions about bonds on the show, is that idea that as the yield goes up, that is a sign of a weakening bond, a weakening currency.
Right.
It was a weird thing. I was like, but I'm getting more money.
You're not, because you purchased the bond at 3% coupon.
Yeah.
The next guy gets to purchase it at 4%. So your 3% coupon is worth less than his 4% because he gets $2 every 6 months. You only get 1.5. So the guy that when rates went up from 3 to 4%, you lost money on your bond.
Yes.
So back to coupon bonds. That's what a coupon is. It's the payment that comes in. Now, if I spend $100 on a bond, I'm going to get that coupon every 6 months for the next 10 years and then have my $100 back at the end. But if I'm in a synthetic bond position, do I just get the coupon for free? No, I have to pay a borrow rate, and as if I'm pretending to finance the bond. So go back to the coupon bond analogy. If I want to buy a $100 bond for 3% coupon, but I don't have $100 and I'm a bank, I can say, hey, I'm going to buy this treasury from you, but you finance it. You give me $98 to finance it. I'll give you $2 today out of my pocket. I'll get the 3% coupon, $1.50 every 6 months, but now I'll also have to pay you 2% interest rate on that $98 I've borrowed. So you have a positive carry and a negative carry. You have the 3% coupon, you have to pay 2% every year for the borrow. We call that the borrow. That's repo. That's what repo is. It's the borrow on the coupon security that you've purchased. So your net yield is only 1% instead of 3%, but you didn't spend any money to do it. Now, an interest rate swap is the same thing. You are receiving a fixed coupon and you're paying a floating coupon that changes with LIBOR over time. And you don't actually care what the difference is between the rates because you are buying that synthetic bond to get exposure to interest movements and interest rates. Like if rates go from 3% to 2%, you better own some bonds today, because if they go down to 2%, you wouldn't have made that money. And if you have to buy bonds next year at 2%, you just gave up 1% yield for the next 30 to 50 years. A lot of these interest rate swaps are done with a 30 to 50 year tenor.
Wow.
Okay, so now let's go back to the UK.
Mm-hmm.
The UK pension plans own UK government bonds. They've paid for them in full. They also own synthetic bonds, interest rate swaps. They haven't paid for those. So when the price goes down, when rates go up, the price of those contracts goes down. What happens? Barclays calls the pension fund and says, you owe me $1 billion.
And this is why it ground to a halt and there was a risk of the funds collapsing.
So how did the UK pension on day one, how did they pay for that? They sold the bonds because they paid for those bonds. So if you've paid $100 for that bond, you sell that bond, you have $100.
So did they sell them or did they use them as like collateral?
They probably sold them.
Right.
Because that's why the rates were going up. They were selling, they were dumping them.
There was a dump on the market.
There was a dump.
Right.
And that sent interest rates up. But you see, they were dumping the bonds themselves because their synthetic bonds were being margin called. That's the downward spiral.
And that's why the government stepped in and said, we will buy them.
We will buy the bonds so that the price doesn't fall.
Yeah.
And then the synthetic bonds, the interest rate swaps, they're not necessarily pegged to the government bonds. There is a basis. I mean, there's a little difference in yield, and that little difference in yield does change with little fundamentals in the market. But all in all, they are mostly linked to the government bond yields. So the derivatives contracts will go back up in price when the Bank of England says, okay, we're going to purchase the government bonds. Now, we saw yields and gilts go from 5% down to 3.5%. And if you can spot check it, they're already back above 4% and rising. So their little intervention has been very short-lived. We see that all across central bank intervention. Interventions are very short-lived. It might require more. I don't have any explicit predictions on what's going to happen in UK government bond market, but 30-year gilts are now 4.37%. So they're up like 60 basis points from the post intervention lows on the yield.
But does this introduce a new risk into the market that if you know the government is going to step in, that you can essentially go out and take more risk?
Yes. And that is the dynamic that we're in, right? So when I talk about reputation...
Nick, do you know what this is like? This is like parenting. My son always knew I'd bail him out. Honestly, he's a wonderful boy. Financially, he's always been a little bit kind of like irresponsible. He knows I will always bail him out. And I have done, and it hasn't been the best parenting. I've tried to teach him, it just hasn't worked. He's now away at university and he has a budget and he has to manage that budget. And so what I'm doing is I'm reducing his budget each month to a point where he's going to get to a lower fixed budget. But I'm having to wean him off that
cheap credit.
Yeah. Yeah, we're in an era of cheap credit that's inflated everything we're buying. But I'm having to wean him off the dad banker free cheap credit.
In the banking world, this is called moral hazard.
Yeah.
And again, like we haven't heard the phrase moral hazard in the financial media in a few years.
Okay.
Because the bailouts have faded, right? We're now 14 years removed from the 2008 bailouts. We're now about 2 years removed from QE infinity in the pandemic. This moral hazard that we're talking about is banks taking undue risk because of the guarantee of central bank bailout or because of the assumption of central bank bailout.